In this week's video, we'll show why failures in the stock market this week put the bear market scenario back on the table. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a daily chart of the S&P 500 in 2008. We'll cover it, then we'll tie 2015 to the concepts in this chart. 50-day moving average in blue helps us discern the intermediate term trend. 200-day moving average in red is used to discern and keep track of the longer trend. Both of them help us smooth out some of this volatility and focus on the trends. This is the peak in October of 2007 in the S&P 500. We come down, we come back up, and we fail above the 200-day moving average. And notice, in the early stages of the bear market, when we come up in this direction, the 50-day is above the 200-day, which is indicative of strength. Down here, we get a rally back to the 200-day that fails. In both instances, when we fail at the 200-day, it's not a good sign. Further along in the bear market, the trend in the market is much weaker, and when we come up to the 200-day, rather than having the 50-day be above the 200-day, the 50-day is lagging behind when we fail here. This period here is weaker than this period here from a trend perspective. After this failure at the 200-day moving average here from point A to point B, the S&P 500 lost an additional 53%. So in this case, the failure at the 200-day was significant, and really bad things happened after that. Now we're looking at the same moving averages in 2015 as of Friday, November 13th. We've got our flat 200-day here. This is not a good look. This is a bullish breakout and now a failed breakout. The 50-day is lagging behind here. So this period here, which was a weaker period than this period here, we really have more of a look like this than a look like this. It doesn't tell us anything about what's going to happen, and we do have some periods in history where we can float around here, but we need to keep an open mind about something along these lines here. Not a forecast, but we've got a vulnerable look here that we're going to respect. What would make us feel better would be two things. A, if price can retake the 200-day moving average, and B, if we can get the 50-day to cross back above the 200-day. We'll shift gears here and talk a little bit about the costs associated with risk management and protecting your capital during difficult periods. This is the S&P 500 as of the close on November 13th, 2015. Unfortunately, we can take today's close and go back almost exactly a year and nothing has happened. This is a trendless environment here. When we were down in the September-October low area here, it was even worse. We could go back to August of 2014. So we had 14 months of a trendless, indecisive market. This is a very, very difficult time for many systems, including the market model. The market model properly cut risk here. Did we have a long-term correction? No, we went straight back up off of one of those odd V bottoms. No problem. The market's model scaled back in. Typically, we would get a sustained rally in this direction. Didn't happen. We had a very muted rally. Did we have a normal correction here? No, we went straight down and saw something that we hadn't seen probably since the 1950s here. Difficult markets do come about from time to time, and there are costs associated with it when you're managing risk. It's whipsaw risk. We've got whipsaws on longer term time frames and lots of whipsawing going on shorter term time frames. Let's compare whipsaw costs to the costs of a bear market. Earlier in the video, we showed that from point A here to point B was a 53% loss. If we went from the peak to the trough, so let's say we decide we don't want to manage risk anymore. The whipsaws are driving us crazy. The little nickel and dime costs are starting to add up. Let's just go back to buy and hold. Buy and hold, 133.27 for SPY. It went all the way down to 58.45. That's a 56% loss. So in this table, we're looking at a potential range of losses in a bear market. And you may say this is extreme. Well, in my lifetime as a professional, I've seen 2 bear markets that have wiped out over 50% of a portfolio's principal under a buy and hold scenario. I've seen it twice, and with central banks keeping interest rates at record lows and experimenting in ways that we haven't seen, I think it's very possible that the next bear market could see a 50 to 60 to 70% loss is within the realm of reason if the markets lose faith in central banks. Let's talk about what it takes to make it back. What this table shows us is if we lose 58% on $1 million, that's $580,000 worth of principal that we lose. Our $1 million after a 58% loss is worth $420,000. How much do we have to make to get back to break even with $420,000? The answer is an eye-popping 138% gain. If I gain 138% on 420,000 and add it back to 420,000, I get back to my original principal value of $1 million. Let's compare that to the whipsaw costs associated with underperforming the S&P 500 during a difficult period. So for argument's sake, let's say we were underperforming the S&P 500 by 5% in a given calendar year. How difficult is it to make up that underperformance? If I lose 5% on $1 million, that's $50,000. I have $950,000 in principal left. I only have to make 5.3% on $950,000 to get back to break even or above $1 million. The moral of the story is managing risk does have costs associated with it, including a high degree of frustration during these difficult periods. However, to leverage the miracle of compounding, which is the objective of the market model, we are allowed to make small and easy to recover from mistakes or periods of underperformance. What we want to avoid is excessive and large drawdowns on our principal that are very, very difficult to recover from. So let's say hypothetically we throw the risk management into the trash can and then we lose 55% of our principal. We're going to have to make 125% just to get back to break even. This type of underperformance here can literally be made up in a day or a few days in a bear market. It's not unusual for stocks to fall 4, 5, 6, even 10% in a week, as we saw during the financial crisis. These numbers can be made up relatively easily, unlike these numbers here. This is the daily chart of the S&P 500. that we posted on Short Takes on Thursday evening. 2039 was the upper range here, 2046. This was resistance here at 2033. We closed below all three levels. We expended a lot of buying power and energy to break back into this upper part of the range, and we just gave it back on very strong volume during Friday's session. This was the lower end of the range that we were watching for several weeks. This is September, this is October, this is a bullish breakout, and this is now a failed bullish breakout. From this point here, the market fell rapidly in this direction. All things being equal, if you're a bull, you prefer to see price recapture this line here. It did not on Friday, and it closed below it. This version allows us to see the lower and upper trend channel. That's an ugly looking candlestick. We lost all of these gains here and all of these levels here. We recently covered all of the good things that happened here, all the levels that we were able to plow right through in this direction. We just gave it all back. Same thing from a weekly perspective. This is a nice bullish breakout here. We closed above these levels. Typically, if this is a real bullish breakout, we would be moving in this direction for some time. Now we can classify this as a failed bullish breakout. We still are learning something from all of these charts. We learn something from a breakout that succeeds. We also learn something from a breakout that fails. Unfortunately, when it fails, what we're learning leans to the bearish end of the spectrum. Dow Daily, as of the close on Friday, November 13th, bullish breakout now becomes a failed bullish breakout. We learn something when this fails. This shows heavy selling pressure on back-to-back days. This day also occurred on strong volume. This is the broader NYSE composite as of the close on Friday, November 13th. Bullish breakout, failed breakout, bullish breakout, now a failed breakout. If you're a client, you can see why on Friday we cut risk fairly significantly, and we will continue to do so if the hard data and the rules require us to do that. This was the bullish gap up in the NASDAQ. The gap was filled on Friday. That takes the runaway gap scenario, balls it up in a little ball, and throws it in the trash can. It's off the table. We learned something from that as well. Looking at the NASDAQ in a little bit more detail, that gap up reclaimed several important levels. We started to move away, and now we've given all of that back in a relatively violent manner. Similar situation here. This is a monthly chart, so it doesn't go into the books for some time. However, this is a bullish break. Now it looks like a failed breakout. You can also make an argument that we have a left shoulder, a big head, and a right shoulder here. If this neckline is broken, we would expect to see another leg down. These were our bullish breaks of the fibs. We gave one of them back on Friday. All things being equal, if you're a bull, you prefer not to see that. It's a weekly chart of the S&P 500 as of a close on Friday, November 13th. Several concerns here. This is support. This is support. Acted as resistance here. If we take this line and move it up here, we get somewhat of an upper trend channel. This is a low, this is a low. This would be the upper part of that trend channel. Price was able to move from the lower end of that trend channel to the upper part, and it was not able to break out. Also, the 22-week moving average, which speaks to longer term trends, tried to turn up here, and instead we have a failure and it's turning back down, and now price is back below a bearish downward sloping 22-week moving average. This is not an encouraging look, and we would prefer to see price move to this side of the 22-week, and we prefer to see it turn up. Also, we lost the move into overbought territory in Williams percent R. This is also negative here the longer it stays down in this area. We also now have a discernible lower high relative to this high here. Similar concerns here on the broader NYSE composite weekly. This is the 22-week here. Look at the slope. We were not even able to exceed the 22-week and were rejected there. And this is an ugly look here. When you go from oversold, rally, and are unable to move back into overbought, has a very, very weak momentum, and this too is a yellow or red flag along with the slope of this line and the fact that price is below it. Is there any reason for hope, especially short-term going into next week? There's always something good that you can find, and there's always a reason for hope. This is the rally, the recent rally from low to high. These are the Fibonacci retracements. We closed very, very close to the 38.2% retracement on Friday, November 13th, telling us there's a very distinct possibility that this could act as support. What once was resistance may now act as support. What once was resistance right here may now act as support. The dotted line is based on closing prices. What once was resistance may now act as support. Another reason for hope is the intersection of these three lines. We'll keep an open mind heading into Monday's session. It's a weekly chart used by the CCM market model. If we can understand extreme examples, we can understand everything in between. This is our full bore bearish look with price below both moving averages, blue below red, and the slopes of both are down. Full bore bullish look, price above both moving averages, blue above red, and the slopes of both are up. How does the same chart look today? The answer is quite a bit more concerning than it looked just a week ago. We don't have the bearish moving average crossover, but we do have a lot of changes on this chart, which is indicative of a lot of things that happened in terms of the data and charts that the market model follows this week. For example, how abrupt was the failure this week? In last week's video, we said one of the submodels tracks 18 different charts similar to this weekly chart. And last week, 18 out of 18 had a full bore bullish look like this. How abrupt and broad were the reversals this week? All 18 of these charts had abrupt reversals similar to the weekly chart of the S&P 500. It's one thing to have a normal retracement. It's another thing to have a broad and sharp reversal, and a reversal that occurred on strong volume like what we saw on Friday, November 13th. Similar concepts, we're just looking at longer duration moving averages. Regular viewers and clients know when we get this tight look here, we typically get a big move in one direction or another, a tighter look here, and a big move in this direction. This is the same chart as of Friday, November 13th. We've got a very, very tight look. Price closed below all of the moving averages. The tight look with price near the moving averages tells us to keep an open mind about a big move in either direction. The momentum off of this week is in this direction. So the move probably leans in this direction a little bit, but history and experience says when price is near this, we should keep an open mind about a move in both directions. For example, price is above here, and eventually the move went in the other direction. Price is below here, tight cluster, the move went in the other direction. So we'll keep an open mind about all outcomes next week, and price will guide us. Earlier in the video, we drew some comparisons between the present-day look of the 200-day and the 50-day in this counter-trend rally in 2008. On these weekly charts, we also have somewhat of a similar look. This is another reason why last week we said the probability of lower lows was the lowest probability outcome of the three major scenarios. That's no longer the case. It's probably an equal probability outcome, and thus risks are higher. We reduce risk to account for that, and price will guide us from here. The market model is designed in such a way that it's always thinking about a full market cycle. How will we handle the case where stocks exceed expectations for the next 3 years? And how will we handle the other extreme case where stocks plummet in the next 3 years? You've got to think about big things, the entire market cycle, while you're doing small things. This quote helps us put the whipsaw insurance and relatively small percentages of underperformance during difficult periods in perspective of the full cycle. This looks a lot more palatable in the context of this. Another one of the big things while we're doing small things is time. The market model will eventually get us in the right place when the market decides to trend again in some manner. In this case, it's a downtrend. That's fine. The model doesn't care whether the trend is up or down. It just wants to see a discernible trend rather than sideways movement like this. From this point here to this point here, this is the dot-com bust bear market, stocks were out of favor for 930 calendar days. That's a long, long time from a time value of money and opportunity cost perspective, and it also puts the whipsaws and the recent frustrations in some additional perspective. If you can't answer the question, how will I handle the next bear market, the next inevitable bear market? The only question is, how much of a hit is your portfolio going to take? In the last two bear markets, it's been a big hit. This insurance is insurance against a difficult to recover from hit. The key to success in these frustrating periods is consistent implementation. Therefore, we will head into next week with a flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.